When the Bureau of Labor Statistics reported a 4.1% unemployment rate, the mainstream financial press largely declared a victory for the American economy, yet behind that single figure lies a net loss of 23,000 jobs and a labor force participation rate plummeting to levels not seen since the height of the COVID-19 lockdowns. This stark contradiction is the foundation of a growing argument, notably championed by financial commentator Peter Schiff, suggesting that the perceived stability of the global financial system is entirely illusory. The premise here is that recent market volatilities are not random failures of capitalism, but the direct mathematical consequences of a decade and a half of unprecedented central bank interventions. We are looking at a dual narrative today: the domestic reality of the U.S. labor market, which exhibits clear symptoms of stagflation, and a complex international shadow game involving the U.S. Federal Reserve, the Bank of Japan, and the sovereign bond market.
The labor market statistics provide a perfect entry point into this illusion. The headline unemployment rate is a highly specific, easily digestible number that dictates public sentiment and political narratives, but the methodology behind it masks deeper structural rot. The unemployment rate only measures people who do not have a job and have actively looked for work in the prior 4 weeks. When workers face a sustained period of rejection or discover that the available jobs do not pay enough to cover the rising costs of food, energy, and healthcare, they experience what economists call the discouraged worker effect. They simply stop looking. The moment they stop looking, they are removed from the labor force denominator. The mathematical result is a drop in the official unemployment rate, which politicians and central bankers then point to as evidence of a robust economy. But the actual economy, the one experienced by Main Street, is contracting in terms of productive output, while simultaneously suffering from persistent price inflation. That is the classical definition of stagflation.
The term stagflation carries heavy historical baggage, immediately invoking the economic malaise of the 1970s. During that era, policymakers faced the seemingly impossible paradox of high inflation alongside high unemployment, a scenario that traditional Keynesian economics at the time deemed highly improbable. The Phillips curve dictated an inverse relationship between inflation and unemployment. Schiff's analysis suggests we are ignoring the modern manifestation of this exact phenomenon. We see stagnant real wage growth. Wages might be rising nominally, but when adjusted for the actual cost of living, the purchasing power of the average worker is actively eroding. If we accept this premise, the structural foundation of the consumer-driven U.S. economy is critically compromised.
The erosion of purchasing power is the insidious engine of stagflation. To understand why this is happening, we have to trace the money. Mainstream economic analysis often treats inflation as a mysterious force, a sudden storm caused by supply chain bottlenecks or geopolitical conflicts. The Austrian economic perspective, which heavily informs Schiff's worldview, defines inflation strictly as an expansion of the money supply. Price increases are the symptom, monetary expansion is the disease. Over the last several years, the M2 money supply expanded at a rate completely detached from the production of actual goods and services. The Federal Reserve printed currency to monetize massive government deficits. Now, the Fed claims to be fighting the resulting price inflation through higher interest rates and quantitative tightening. But this fight is fundamentally compromised by the sheer scale of the national debt and the fragile nature of global currency markets.
Brings us to the international dimension, which is arguably where the most alarming systemic risks are currently concentrated. The situation with the Bank of Japan and the Japanese yen is a prime example of how central bank policies are colliding on a global scale. Recently, the yen fell to a 40-year low against the US dollar. Japanese government bond yields were soaring, placing the Bank of Japan in an incredibly precarious position. The standard defense mechanism for a central bank trying to prop up its currency is to sell foreign exchange reserves. For Japan, the largest foreign holder of United States Treasury securities, that means dumping American debt onto the open market.
Dumping U.S. Treasuries is the nuclear option. If the Bank of Japan were to aggressively sell off its massive holdings of U.S. debt to buy yen, the influx of treasuries hitting the open market would crater bond prices. Because bond prices and interest rates move inversely, this sell-off would cause U.S. Treasury yields to spike violently. A sudden, uncontrolled spike in U.S. interest rates would ripple through the entire global financial system. Mortgage rates would skyrocket, corporate borrowing costs would become prohibitive, and the cost of servicing the staggering U.S. national debt would blow an even larger hole in the federal budget. It would likely trigger an immediate, severe recession, if not a full-blown financial crisis. The Federal Reserve understood this systemic threat perfectly.
To prevent that open market sale, the Federal Reserve intervened through a mechanism known as a repurchase agreement, or a repo swap. This is a highly technical maneuver that happens far from the public eye. Instead of Japan selling its U.S. bonds, the Federal Reserve effectively lent Japan the U.S. dollars it needed, taking the Japanese-held treasuries as collateral. Japan gets the dollars required to intervene in the currency markets and stabilize the yen, and the U.S. bond market avoids a catastrophic supply shock. It looks like a brilliant, seamless solution.
It is a seamless solution only if you ignore the mechanics of how the Federal Reserve sources those dollars. The Fed does not have a vault of pre-existing tax revenue to lend to the Bank of Japan. It creates those dollars out of thin air. By extending this massive dollar liquidity to Japan, the Federal Reserve is engaging in stealth quantitative easing. The Fed is expanding its balance sheet and injecting new liquidity into the global system at the exact same time it is publicly claiming to be tightening monetary policy to fight domestic inflation. They are creating new money to prevent a debt crisis, which inherently dilutes the purchasing power of all existing dollars. This is why analysts like Schiff argue that the Fed's inflation fight is a facade. When forced to choose between fighting inflation and preventing a sovereign debt market collapse, the central bank will always choose to protect the bond market.
This exposes a fundamental tension in modern monetary theory. Mainstream policymakers argue that these liquidity swap lines are essential tools for maintaining global financial stability. They view the Fed as the ultimate backstop, the lender of last resort for the global dollar system. From that perspective, providing dollars to the Bank of Japan is a responsible act of international financial diplomacy. It prevents a disorderly market collapse that would harm everyone. The counter-argument is that this is simply kicking the can down the road, suppressing natural market signals. If U.S. debt is unattractive at current yields, market forces should dictate a price discovery process. By short-circuiting that process, the central banks are building an increasingly unstable tower of debt.
Price discovery is the crucial concept here. In a free market, interest rates are the price of money. They signal risk and dictate the allocation of capital. When central banks intervene to artificially suppress interest rates, whether through direct quantitative easing or these shadow repo agreements, they destroy the pricing mechanism. Capital is misallocated into unproductive sectors, creating massive financial bubbles. We have witnessed a decade and a half of zero interest rate policy, which conditioned entire economies to rely on cheap debt. Now that inflation has forced rates higher, the structural vulnerabilities are being exposed. The Bank of Japan's dilemma is just the first major fracture. The U.S. government is running multi-trillion-dollar deficits during what is ostensibly an economic expansion. Who is going to buy all that new debt if foreign central banks like Japan and China are no longer accumulating treasuries?
If foreign demand for U.S. debt dries up, the buyer of last resort has to be the Federal Reserve, and that leads directly to the lull before the storm thesis. Market participants are not entirely blind to these mechanics. We are seeing a profound shift in asset classes that traditionally serve as safe havens against monetary debasement. The explosive rallies in precious metals, specifically gold and silver, are impossible to ignore. Gold recently hit record highs, not because industrial demand suddenly spiked, but because institutional and retail investors, along with foreign central banks, are aggressively seeking protection.
Gold is acting precisely as the canary in the coal mine. Historically, gold is the ultimate hedge against sovereign default and currency devaluation. It carries no counterparty risk. When you hold physical gold, you're not relying on a government to honor a debt or a central bank to manage a currency responsibly. The central banks themselves understand this better than anyone. While the Federal Reserve manages these complex swap lines to prop up the dollar system, central banks in nations like China, India, and Russia have been accumulating gold at the fastest pace in modern history. They are quietly de-dollarizing their reserves. The market is pricing in the inevitability of further monetary expansion. If the structural issues, massive deficits, slowing growth, and an over-leveraged financial system are solved by printing more money, the purchasing power of fiat currencies will continue to plummet.
The pivot from relying on mainstream economic propaganda to adopting personal financial preparation seems entirely rational under these conditions. The narrative of a strong, resilient economy is fundamentally at odds with the frantic, behind-the-scenes interventions required to keep the bond markets functioning. The disconnect between the official statistics and the lived reality of the average citizen is widening. We are witnessing the consequences of an era where the price of money has been politically determined rather than market-driven. Understanding this dynamic is no longer an academic exercise. It is the prerequisite for navigating the coming volatility.
The transition from a system of artificial stability to one of genuine price discovery is rarely smooth. The interventions we discussed, the manipulation of labor statistics through participation rates, the stealth QE through foreign repo markets, these are all delaying tactics. They treat the symptoms of a debt crisis rather than addressing the root cause, which is an unsustainable level of leverage across governments, corporations, and households. The ultimate resolution will likely require a significant devaluation of debt in real terms, achieved through sustained, elevated inflation. Recognizing that the rules of the game are changing is the first step. The assets that performed well during the era of artificial stability are not necessarily the ones that will protect wealth during a period of monetary reckoning.
As the underlying mechanics of these interventions become clearer, the illusion of stability rapidly fades, leaving us to navigate the structural realities beneath. Send this episode to a friend who is trying to make sense of these market shifts.